Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Okay, starting in 5, 4, 3, 2, 1. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and programming at DealCatalyst. And you know, when I launched the podcast, we said we'd eventually kind of switch up, what those episodes might look like, formats, topics. And so today is the first of those episodes. And so, we're going to run through a number of things, in this episode today. First is, we just came off of 2 days of our asset-based finance or ABF 2025 event in New York City with about 700 attendees. So I want to cover some of the top trends that I heard from that event in ABF. I also want to have a little fun, touch on the Ryder Cup, the Mets, some of the things happening around sports here in New York. And so, we're going to have a little fun on this Ryder Cup Friday. I have my Bethpage Black PGA Championship, pullover on in honor of the Ryder Cup, which, to be honest, thus far has not been going very well for the U.S. team. They're down 3-1, and they're, I think, all square on 2 events this afternoon, and each is up. So we're looking at quite the deficit heading into the weekend. And, listening to, some of the commentators, the last few hours while watching the event, the U.S. hasn't come back from a deficit of 2 or more on that first morning since the early 70s. I think it was 1972. And so we're looking at what could be a bit of a rough weekend for the U.S. team if they can't turn it around, at least maybe have a little bit of a surge here this afternoon and then kick off tomorrow. It just always seems the Ryder Cup has been a better and more constructive format for the European team, which actually feels like a team. I think when watching it, it even goes back to the early 2000s, mid 2000s with Tiger and Phil. It felt like a collection of individuals and players versus an actual team. And it feels like the European contingent tends to form more as a team. I think this is almost the exact same team that beat the U.S. team in Rome a couple of years ago. And they're off to another fast start. I do think at some point that the local advantage here in Bethpage, the rowdiness of the crowd will come into the U.S. favor. And I think you could see that tomorrow, and maybe Sunday's a bit more of a narrow gap. And they're, maybe down 1.5 or still down the 2. And in singles, you can obviously make that up, fairly quickly to see who wins on Sunday. And hopefully you get a compelling match because it's the U.S. has never really excelled at this. Back in the early time of the Ryder Cup in the 30s and 40s, the U.S. was dominant, and I think they allowed all of Europe in the early 70s, with Seve and others. And so it became kind of a different dynamic when some of those players came in, and it seems like Europe has really taken more of a liking to the format than the U.S. has. So I'm curious to see how that turns out. Unfortunately, I won't be going, but hopefully the U.S. can give us a little bit of a surge as we head into the weekend and give us something to cheer about for the Ryder Cup, because a couple of years ago wasn't very fun watching the U.S. kind of get a bit overrun in Rome. going back to the top trends in ABF, we had spent the last few days at the Marriott Marquis for our fourth annual ABF conference, and we had about 700 attendees. Pretty significant growth from last year's event, and just considering where it was just a few years ago. Clearly, you can tell. I think the two things kind of the ABF market is on an upward trajectory, obviously, along with the event, and as people look to diversify away from strategies they're a bit more accustomed to, which is your traditional corporate straight down the fairway direct lending, and as they begin to kind of look outside for some asset classes that can offer a bit more yield, you're seeing just this intense growth amongst some of these asset classes. And listening in on panels and running the sessions for the last day and a half, it was really interesting to hear some of the key themes. And when you think of what might be the hottest topics in ABF today, I think you probably have to start with data centers and digital infrastructure. I mean, just on the eve of us starting opening remarks and me going up to the stage, you get a notification from Bloomberg that Blue Owl and the Qatari Investment Authority have a $3 billion partnership for data centers, and so it just speaks to a few key trends that we're seeing in the market. One is obviously the continued adoption of AI and other fast and increased speed of computing. And so with that comes a ton of opportunity. And you heard it throughout. I mean, our first session all the way through to one of our final panels today. I mean, the thematic kind of underlying, part of the event was digital infra, AI. How can we, begin to package some of these things in all kinds of different structures? And it really, I think, speaks to kind of a couple of different things. One is the increased adoption amongst consumers like me and others who are utilizing more of this AI technology, and also looking for faster speeds in our home. I think you have to move beyond just what are data centers and what are they offering when it comes to ChatGPT or some of these other AI technologies, but how fast can internet get in our homes? I mean, I'm doing this episode from my home office. Can we get that type of technology to everywhere in the country? And so you have high speed, fast internet where you've probably never had it before. And what is that? What is the kind of cascading effects for the industry that we cover, private credit and structured finance? And you're seeing all sorts of kind of nifty and interesting models come around with digital infrastructure, going from the data center itself to equipment inside the data center to cooling to power trading. I mean, so much of this can be taken, packaged, put in an SPV, securitized, sold, tranched. I mean, it's quite interesting that it feels, at least sometime in the next couple of years, you're going to have like this digital infra spin-off in some ways of the ABF industry. At least it feels like it has that potential. And so I think when thinking about the event and kind of the top theme is probably digital infrastructure more broadly, and you don't want to forget about fiber and other things which come along with it. And so, when talking to folks and listening in on panels, I'd probably say digital infrastructure was the top theme coming out of the event. The second one, which is probably no surprise, to anyone in the industry, is the continued adoption or continued ability for deals to get structured and rated for insurance capital. And so, insurance, we had some insurance companies speak at the conference, and there's a larger numbers of insurance companies coming to the conference. I think overall we had about 130 asset allocators. We define that as, pensions, family offices, and obviously insurance companies, which is a big jump from last year. And we continue to see growth for that segment. And I'd probably say outside of data centers, how can I structure transactions for insurance capital is probably the next biggest thing. And as insurance companies, are looking for longer dated assets, they are also looking to diversify away from your traditional corporate direct lending. And one thing I'm starting to wonder about the insurance capital aspect to it is, kind of where, with the amount of capital going into the space, is there enough deal flow, or do we start going down the path of deterioration, and the deal flow is chased, the money's chasing deal flow for the sake of, hey, I have to allocate this, I've raised money from insurance companies, or I have to get these transactions done. The other thing is, as more of these areas in the market begin to become intertwined and really cross-pollinated with one another, how does some of this risk look like from a regulatory perspective? Because a lot of the funds, the private credit funds that are coming to the event, we had 150 plus there. They're backed by insurance companies. They all set up rated feeders. Insurance companies also buy into the funds that way. The insurance companies are also lenders in fund finance. And so you have kind of this circular notion of kind of this capital, from credit fund to originator to package to back to insurance company to credit fund to originator and packaged. And it makes you wonder kind of where the risk sits, at what point, and what that risk looked like. And I think today, there's certainly more structurally, there's more protections in place than when, we came out of the GFC back in 08, 09, and then obviously, into the 2010s. But, there's also a little bit of that undercurrent, in the audience of kind of where does some of this eventually end up, and what does that look like in the next few years as more capital just continues to flood into the market. I think it was Aries that says, ABF is, not Aries, Carlisle says ABF is a $20 trillion opportunity. And I think today it's somewhere between 5 and 7, depending on how you define what that opportunity looks like. But, the circular notion of where that risk sits, especially as you might have more of a muted SRT market. Curious to kind of where all that goes, but certainly the second biggest theme coming out of the conference is how to structure transactions and get them rated, for insurance balance sheets. And so, I think that is along with digital infra is probably going to continue pretty unabated, over the next few years. And, I think I don't see, at least hearing and talking to folks in the industry, a real slowdown there. So another trend, I saw coming out of the conference is just how much more is continuing to go into the private markets. The yield is certainly being compressed with public to private. And I think it's, very curious to find in the next few years how much of that spread compression continues. I think one of our speakers at some point said it was somewhere between 50 and 30 basis points, which is fairly tight. And then the other thing is, when you're going to a private transaction, how much more control, and how much more flexibility you can do when it comes to deal terms. And I don't think it was meant in the sense of transactions being either worse or competing to not put certain parameters into a deal. I think it's in the private markets. There's so much that can be negotiated, which I think really brings different levels of kind of where this power is going to sit, for the transaction. I think that shift is just going to continue, over the next few years as more and more capital goes into the private space. And I think many panels had talked about, the ability to negotiate and really get, very, granular with how you can put a transaction together. The capital is very flexible. The terms can be very flexible. And, in many ways, these deals are done a lot faster in the private markets, which is, I think, another reason why, when looking at, options, if I was an originator, you might look to a private credit fund, to help you with some of these, big facilities that you need to ultimately lend because you're not a bank. And so I thought hearing that kind of over the course of the 2 days was pretty interesting. Of not only we know that more money is going into private, but what it kind of brings with it when transactions are actually consummated and deals are being negotiated. What that really means, for the originator and ultimately the provider of capital, as well. And so I think, those I would say are the top three themes coming out of the event. Digital infrastructure, clearly the top thing that people were talking about. Even the Bloomberg piece with Blue Owl and the Qatari Investment Authority. Clearly the need to continue to access and structure, for insurance capital. And the third is just the benefits of, what a private transaction brings with it, other than obviously private credit and private capital. But what else comes along with it? Deal terms more flexible, speed and flexibility of that capital. More control if something goes wrong and what might happen to those underlying assets or underlying company. And so I think when looking at the event, those were probably the top three themes. A couple other things I thought were interesting. I come from a fintech background, and I think it's fintechs have had quite a journey from originally saying, hey, we're going to reshape the banking system, which clearly didn't happen. They've adjusted the banking system, certainly from a speed, and customer experience, part. But I don't think they underestimated the cost of marketing and the cost of capital when you're not taking deposits. And so I think seeing the connective tissue starting to kind of come together with fintech originators who used to go to the event I ran, Lend It, 2016, 17, 18, beginning to kind of connect that tissue to private credit and what that is starting to look like. I mean, you had tons of fintech originators coming to the conference. Used to be called marketplace lenders, then online lenders, and now they're really just lenders in many ways. I mean, we had the CEO and the founder of Upgrade, who used to, obviously started and used to be CEO and founder of Lending Club. We also had the chief capital officer at a firm. Both of those spoke about just this abundance of funding options and the ability to build a capital stack that has flexibility, that has some structured and, kind of down the middle, optionality to it, as well as small, bespoke, flexible, really creative, deal activity to it. And I think seeing how firms like Affirm and Upgrade have continued to evolve, and then starting to see some of the other fintech originators that I used to talk with and speak with at Lendit, I think is a really interesting trend that we might start seeing in the next few years. I still don't think a lot of those folks think of themselves in asset-based finance, but essentially they are. I mean, they're originating an asset that ultimately is packaged and sold to investors, and then rinse and repeat, rinse and repeat. And I think, it's still surprising to see a lot of fintech lenders that have not yet figured out how do I make money. And I think part of that might be the niche or monoline, business model that they might be in, and they've had to diversify, away from that. But I think you're starting to see more of a fintech and, private credit connective tissue. And so, I think that's another thing that, is really interesting, to begin seeing. And then I'd say the last one would be, just this, appetite, for assets that are kind of way off the beaten path. And so, we had one panel that talked about art to oil and gas, to, oh, what was, there was a really funky thing like, a piece of farmland that can be funded and then packaged and sold off in some structure. And I think the more that some of these asset classes maybe jump up from esoteric to mainstream, I think investors will start to become a bit more aware of, hey, music royalties. We've seen some artists sell off their books for hundreds of millions of dollars. Arts, there's plenty of places that let you put up your art collateral to take out a loan. Home equity investment, which I think is one of the more interesting areas that is really starting to be tapped into. Especially, I mean, it falls right into the wheelhouse for me, which is, very low interest rate. We've refied in COVID and gaining equity value in our home. We're not going to refi. We would, right now we'd say, why would we take on another payment with like a HELOC? And so does something like an HEI become appealing to the folks that might be in a similar situation as I? And what does that use of proceeds begin to look like? Am I doing it for debt consolidation? Am I doing it to, build up my house or build out my house or put in a pool? And I think there's a whole swath of homeowners who have really good interest rates that see no value in, refining up to something that is, double where they might be today, or at least 40 or 50% higher, taking on that extra cost when they can do something with no payments. I do wonder kind of where that industry might begin to land when, these investors who, in many other instances, get, traditional cash flow coming from, these structures, that they're not getting that same setup here. And if people now today it's not being done. Most people I think are cashing out or selling their home or doing something additional and using this more as a bridge product. But I think sometime we're going to start to see people using it and holding it. Like, hey, I've done this transaction. I'm going to stay in my home for the length of the home. It's a 30-year product. Curious kind of how the appetite from investors might view that product if you start to see a bit more of a bifurcation between the short-term bridge crowd and those that might ultimately hold it, for the full term, whether that be 10 and 30. And I think those are the core products that are in the market today. But I mean, overall, it was a really, really great 2 days. 700 attendees, just about. I think I mentioned earlier, 130 asset allocators, 150 plus credit funds, all the big names there, and then 170 plus asset originators, specialty lenders, fintech lenders. And I think as ABF continues to really grow and take off, you're starting to really see the diversification of different optionality for funding these lenders, and I think it's super exciting to see as we build our event, but for the market itself, I think there's a lot of greenfield that hasn't yet been explored in ABF, and I think you're starting to see that exploration take place today. And then, of course, what happens with does data centers become kind of its own asset class, splintered or carved out of ABF? Does something else go from esoteric to mainstream in the next few years? HEI, for example. I mean, I think you're starting to see a lot of activity in ABF, and a lot of asset allocators have told us, and in conversations with them, you hear it, which is they really haven't fully explored this asset class just yet. And so there's a ton of capital that is not yet come into the space. I mean, we talked earlier about how much capital is already in the space, and it seems like it's endless. And does that come to a point where it's chasing bad deals or bad assets? And just think of how much is still on the sidelines. So, over the course of the 2 days, it was just a fantastic conference. A lot of fun, a lot of good activity, a lot of good conversations, and obviously a great team that we have at DealCatalyst. Before I leave you, I just wanted to touch on a couple of personal fun things when it comes to sports. I'm a big Mets fan, a big Bills fan, big Notre Dame fan, and the Mets are in the midst of, I guess you can call it somewhat of another collapse, and curious to see where this season ends up. So they're up 1 game on the Reds, 2 games on the Diamondbacks, with 3 to play against, of course, the Florida Marlins, who ruined our seasons in 2007, 2008, the last games at Shea Stadium. And I'm really hoping it doesn't turn out like that again. The Marlins have caused me many a pain over the years, and it just seems like they are that team who's seemingly not good, though they've won 2 World Series since starting in 1997 and 2003. But they just tend to be like gnaw at you. They're kind of like an annoying animal that's like gnawing at your legs, or a dog that kind of won't leave your ankles alone. The Marlins kind of feel like that for the Mets. It's like the Mets, when looking at the rosters, the Mets are clearly the better roster. But for some reason, the Marlins have this ability to either beat the Mets or make a play that they need to play, that play they need to make. And it's just incredibly frustrating to watch these games. It takes years off my life. At least I hope it doesn't come to that this weekend. I come around for next week's episode, and I'm in a bit of a misery complex, considering the Mets are out of the playoffs and they spent almost $450 million on the baseball team, which is historic in many, many ways. But I think you'll find a lot of fun things this weekend in baseball, and really in sports in general. Yankees and the Blue Jays are in a tight race for the division. The Tigers are in the midst of their own collapse. I think they were up 15 and a half games in August, and you're seeing that team collapse. I think these days it's really interesting in sports. You're seeing a bigger push when it comes to gaps, or someone's down 20 games, or you're seeing that comeback happen a bit more. I mean, if you look at statistics in sports, which I have done pretty much my whole life, these things did not happen a long time ago. It was like once in every 20 years. It feels like every year someone's coming back from 10 games or 15 games. I mean, the Miracle Mets of '69 did it. Like, they were down 10 in mid to late August and came back. But it was very few and far between. And in the last 10 or 15 years, you're starting to see that a lot more. And it's a curious trend. I think it makes for fun when it comes to sports. But I also think it's, for someone who, like me, who follows sports as closely as I do, it's, it feels like it takes years off your life. I mean, it feels like my kids take years off my life, but my teams do the same, which is can be incredibly frustrating. And then, I think around here, certainly the Ryder Cup is, key to the weekend. What might happen with the USA team, and then the other thing is the New York football teams, who have been very bad for a very long time, except for the Bills, who do play in New York. People who don't think Buffalo might be a part of New York, it is, and they're 3-0. The Giants and Jets are 0-3. But at least the Giants now have the hope of their new quarterback in Jackson Dart, Ole Miss grad, who's starting, and we'll see if it changes the fortunes of that team. I think, when it comes to, the core reason we have this show, credit in sports, when we'll start to explore that a little bit more in coming weeks, and we'll start to play around with sports a little bit more too, because I just have so much fun talking about it. But there's such a connection that's beginning to take place with private credit sports, private equity in sports. I mean, it is really, I think, other than if you look at, like, here's direct lending, here's ABF, like, sports finance is, that might be maybe next year or the year after might be the asset class I come on this show and say, hey, key themes coming out of ABF, and it would be sports finance. I mean, it has such an opportunity that goes from buying into the teams to player transfers to NIL in college to stadium builds to providing funding to acquire broadcasting rights. I mean, there is so much capital invested in sports, and there's such a passion for sports. I mean, just listen to me talk about sports. That it's something that you're going to see in the next few years that really, I think, takes off in a really significant way. The NFL just opened up to private equity buyers this year. I think they can get up to 10% of a team. The Bills did it. The Dolphins did it. And there were a number of teams. I think the Patriots are selling a part of their team. I think up to 10% at a $9 billion valuation. So, sports is, always been a key piece, to society here in the U.S. and even in Europe with Premier League soccer. And you started to see private credit. I think Oaktree and one of the big teams in Europe did a transaction, and you're only going to see more and more of that, especially trying to tap into the player empowerment, which is, we're certainly in an era of player empowerment, and then the broadcast piece to it, and where that broadcast is, whether it be on our phones in our hands, the TV, the tablet, streaming. I mean, all this is interconnected, to one another. And in many ways, private credit is the kind of the main piece of connective tissue. And as more capital goes into the space, you have more optionality for a lot of these different asset classes that we've been talking about today. So thank you always for listening. If you have a show idea, please don't be shy. Please reach out. I'm always interested to talk to new folks, ABF, direct lending. If it has a tangential connection to credit, I'm open to discussing it, even if it's a funky, weird idea, or if it's straight down the fairway. Private credit, direct lending, I'm open to all of it. I really appreciate you listening and being a part of the show so far. So please rate and review. I always look at those and try to take as much criticism and put it into the show as I can. And really appreciate the time that you spend with me. A couple of quick things as I leave here. We have another batch of events coming up in the next few weeks. Next week, we have our UK Mortgage Conference. If you're not yet registered, you should do that right away, because I think registration's probably closing soon. Then we have our SRT conference, October 6th in New York City. So please register for that if you have not yet done so. We'll be in Dubai in 2 weeks, covering our fixed income alternatives. Dubai, and then ending the year with our SLF, which is coming full circle to ABF. It's our ABF conference in the UK, and for the UK and Europe audiences. That one has about 1,000 attendees. So if you have not yet gotten your pass, please do so. And as always, appreciate the support from all of our sponsors at our events. If you want to sponsor an episode of this, please reach out. Thanks so much, everyone. See you next time. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.